working in favor of PFCREC according to the House of Bernstein. But let me now welcome on board Satyanarayana Raju, the MD and CEO at Canara Bank, to talk about how their numbers were. Mr. Raju, first let's talk about the numbers. Interest income has increased by 14%, but it translated into a 5% uptick in your NII. Your cost of funds are up while yields on advances went well down. Help us understand what's the overall outlook for, say, the next 2 years.
The yield on advance declining may not happen at this moment unless otherwise the regulator will come out with a rate cut. Till that time, the yield on advances, we can say that we can confidently say that may be already reached to the peak. It may be there at that level itself. But the cost of funds is a market driven. The cost of funds nowadays, even now, every bank is finding it difficult to raise the funds at a cheaper cost. For government banks, because of the sovereign guarantee, raising the deposit is not the issue, but the rising at a cheaper cost is the main concern. So nowadays the CASA is not growing as expected. It's growing in our bank also. It's growing. As SB individual is growing in absolute numbers in a year on year. It has grown net is 12,000 crores, but actually SB individuals we have grown more than 18,000 crores. We have lost some deposits in the institutional deposits in the savings bank. But the rising term deposits, retail term deposits is become a very costly affair because the term deposits average cost is around more than 7%. And if you go to the bulk deposits on CD, it is ranging between the 7.5 to 7.8%. At that level, incremental deposit growing is maintaining the margins definitely is a tough task. So unless otherwise the liquidity in the system softens in the next 1 or 2 quarters, otherwise the stress on the NIM will continue in the coming quarters too.
On the same line, NIMs are now at about 3%, although still in the guided range, but there is no cushion left from here on. Do you think NIMs increase in coming quarters or remain at same levels?
No, but the general tendency is the first quarter NIM will be reflected little lower. Gradually, second, third, and fourth quarter, slightly improvement will be there. So if you look at that in that aspect, keeping in the past experience and all, this 2.90 may increase or improve up to 2.95. That's what we are expecting finally at the end of the year. Our NIM may stabilize at 2.90, subject to if the yields are continuing at that level and cost of deposit if we continue at the present level.
Right. Let's also now talk about the asset quality because you've shown an impressive improvement and then some banks are struggling. Fresh slippages are down for you. Credit cost is below 1%. Do you think credit cost is going to sustain at these levels? Because you've got it for 1.1%, which still leaves a little headroom.
That's what we strongly believe that we can maintain below 1%. Though the guidance we are given 1.10%, that's a conservative approach. But we can, because last quarter itself, March quarter itself, we have shown less than 1%, and we definitely confident that we can maintain it. For that, the major portion is what we are, it's a two-way approach, we are adopting it. One is first the main approach, what we are thinking, not on the recoveries, we main approach on the avoiding the slippages at the level of the SMA 0, 1, 2, that itself we started addressing the problem of that customer. There itself we have strengthened our recovery process. If you look at SMA 1 and 2, even year on year or even a sequentially quarter on quarter, both in absolute numbers and the percentage wise, it has come down. Year on year, if you see that the percentage is 0.77%, now it has come down to 0.51%. Even sequentially also, it has come down from 0.53 to 0.51. That shows that whatever the steps we have taken on the recovery in the stressed assets itself, without slipping to before slippage itself, that has started giving the results.
So in terms of the MSME and the asset quality, there is a concern. But at the same time, we've seen government coming up with credit support schemes through the budget. How do you see these schemes and will this increase your MSME exposure?
Definitely post-COVID, some hit was there for the MSME compared to other sectors. But that has resulted little higher NPAs or slippages in the MSME sector. 3 years back, our MSME NPA was around 14%. Now it has come down to 8.4%. The reason behind that is one is credit guarantee support from the government, various area-wise schemes, cluster-wise schemes on the advice of the government what the bank has introduced. We have revisited all our underwriting standards. We centralized, we created almost 156 SME Sulabs in various places so that the processing and the underwriting standard to improve that standards. And below 10 lakh crores, the 10 lakh loan tickets, all the loan amounts below 10 lakhs have been digitized and business rule engines have been implemented there. So that also has controlled the slippages. These are all the various actions what we have taken both at the government side as well as in the bank side. It is helping in growing that.
Also want to talk about your loan growth because you reported around 9.8% growth for the quarter. I see MSME and corporate growth were key drags. Is it a cautious step to try and protect your asset quality?
So our credit growth guidance, we are given 10%. But last time when I interacted with all of you, I confirmed that by the end of this financial year, our credit growth definitely will be around 11 to 12%. Still, I repeated the same statement stating that by the end of this financial year, our credit growth may touch around 11 to 12%. The reason behind is our focus on the RAM sector is continuing. Our RAM sector is growing about 12% even today. Our corporate sector is showing a little less growth. The reason behind that, last time also I shared that we have some low yielding advances at a short term periods, which we don't want to renew unless otherwise we get an attractive rate of interest. So last March quarter, we have shed almost 20,000 low yielding advances and we have taken it back. And the current June quarter also, we have taken it back almost 22,500 crores. These low yielding advances from some central government NBFCs or even other NBFC, AAA rated NBFCs. That's the reason our NBFC exposure has come down from last year on year, last June to this June, from 1,44,800 to 1,18,000. There is a reduction in the almost 25,000 crores, 26,000 crores in that.
So CD ratios are at 73%. It seems that you have enough headroom from growth without raising capital from the open market. How are you looking at growth and funding requirements?
One is first CD ratio. So 3 years back, our CD ratio was 67%. Now we are reached to 73%. Middle of the last financial year, even we are touched 74%. But since the liquidity in the market is in tough conditions, as the advice given by the regulator, the incremental CD ratio we are restricting to less than 100%. That's why we are able to keep that at 75, below 75% ideally. That's why our focus more on even deposits. If you see the last year growth, our deposit growth is and the advances growth both are 11.24, 11.3. That is the range. And the current first quarter also, our deposit growth is more than 11%, our advances near to the 10%. So we expect that the deposit and credit both will grow about 10% in the next 3 quarters. Regarding the capital, with that growth rate, our existing capital adequacy ratio is 16.38, which is very, very, very sound. If you look at even CET1, first time in the history of the Canara Bank, we have crossed 12% and it is now at 12.05% as against a regulatory requirement of 8%. So with that comfort, I don't see any reason to go to the public for raising a core capital. But however, the board has permitted us to raise from the market the 8,500 crores capital. Out of that, 4,000 crores in 81 bonds and 4,500 crores is Tier 2 bonds.
Right. So good to speak with you today, Mr. Raju. Thank you so much for taking the time out and joining in today.
If you like this video, then like, share and subscribe to ET Now.